Yeah, let's just jump right in. All right, guys, we are back with another episode of The Deep End, and we have another very special guest with us today. We are joined by the silky smooth, the one and only Spencer Dunbar, aka Spencer Invest. Spencer, man, first and foremost, thank you for taking the time today. We're happy to chat with you. And second, how are you? Let's just start there. How you doing?
I'm doing great. I've got to say thank you guys for having me on. We talked about this, a few minutes ago. I've been watching you guys, your content for I don't know how long. I don't know how small of channels you guys had. I don't know how much they've ballooned since then, but I was watching you guys years before I was ever even making content. So it's a pleasure to be here. It's really surreal is one way to put it. And that intro, I've never been called silky smooth. So there we go. Starting off real strong.
I don't know where that came from, so I apologize for that. But
And
Uh,
it's an
it just
honor to
kinda
have you on. It's such an
it's
honor. You're
amazing to be
silky
here.
smooth.
I'm going to use that now. I'll make a little smaller channel. Silky
it's
smooth
pretty
fans.
funny. It's pretty funny. I've had my own kind of full circle moments in this investing journey as well. One of them was talking and like getting to hang out with PPC Ian. That was one of the big highlights of like my investing journey, my YouTube journey. And that's kind of the crazy thing. First of all, I'm flattered, but what I was going to say was that's kind of the crazy thing about this, making videos on the internet. And I always say this, you never know what those things can grow into. You never know where those things are going to go and who that's going to connect you with. And so it's really cool. I think we're really fortunate to live in a time where we can do this. And I don't know, life's crazy sometimes. I think that's really the point that I wanted to make. It's just very unexpected in so many great ways.
Definitely. Well, and I always, they say like, don't meet your heroes, but that's not the case in a lot of these things, like it's been so cool meeting gentlemen like yourselves that are so successful in this industry and learning. I mean, it's crazy how much you can learn from someone that's gone through the steps prior. So really, it's awesome. It's awesome to be here. Super grateful.
Well, man, give yourself some credit too. Like, I don't know exactly how long you've been investing, but, in the time that you've been doing it, you've built up quite the portfolio. I think you're 28 years old, right?
28, yes.
Portfolios maybe about 30,000. Dividend incomes maybe about 2,500. Do I have those stats right, or am I tripping on that?
You're pretty close. It ranges. Dividend income annually is about 3,500. Last I checked.
Holy cow, I was way off.
And annually, yeah, but it's all right. It varies because I change things around too often. But portfolio value is sitting at about, I think we're almost to 40,000. I've made some mistakes by creating so many portfolios for YouTube challenges. So I have a bunch of money that's not reflected, and I'm trying to consolidate everything now and get everything set up to where it's just one account and I don't have to, handle, because come tax season, it's a disaster because I've literally gone to my account and go, I have 7 different brokerage statements we got to input in this data, and it ends up being, a pretty hefty fee. But yeah, so it's spread out quite a bit. I started dividend investing pretty young. I was really risk averse. I started off with only Fidelity ETFs, low expense ratio, growth. And then about a year and I was like, this really hasn't done much whatsoever. And that was in college when I was doing this, working part-time, trying to pay my way through school and whatnot. And so from there, yeah, things have just ballooned, and it's crazy to think of, $40,000 sitting in my account right now, but it's been a blessing. It's been cool. And I am self-taught, I would say.
Yeah.
I say self-taught, but like it's from YouTube, from other people that have gone through these things that really have kind of educated me on the entire space. And so my background is not in finance whatsoever. YouTube is not, people ask me if I do YouTube full-time, not even close. I have a full 9 to 5 on top of that. So it's really interesting. I feel like I live a double life sometimes, where it's like, I go to work, I do something, I'm in the field of biology for my 9 to 5, which is so vastly different. Whenever I talk to people about that, they're like, that's super weird. How did you get into making stock content on YouTube? And so it's really cool, but it is kind of like a double life. I get to, have my 9 to 5 that kind of pays for my passion, which is YouTube investing, and growing, hopefully generational wealth is the goal.
Yeah.
You know
who
what's
else
really
lived a
cool?
double life? Real quick, you know who else lived a double life? Batman.
I would consider myself similar to Batman in a number of ways.
I see it, man. That's why I brought it up, because you're the spitting image. You're like investing's Bruce Wayne. But all right, man, I'm sorry to cut you off. What were you
Ryan's
gonna
coming
say?
in with some lines on this episode, man. From silky smooth to Batman.
Dude,
what's in that tea?
There's something in this body armor.
It's the body
Shout out,
armor.
That's what it
shout
is.
out
It's body
Coca-Cola.
armor. It has that effect, I've heard.
Oh yeah.
I highly recommend these. But go ahead, Ari. I'm sorry, man.
Here's what I'm thinking about as I'm listening to Ryan's lines and Spencer tell us a little bit about himself. I'm thinking about how different of investors all three of us really are, and I just think it's really awesome to highlight that in of itself. So Spencer, you are all in on ETFs, and more than that, I mean, I want to say, like, you are Mr. ETF of YouTube, and you have trial and errored a lot of them, and that's very unique. I've never seen anything like that. I was obviously into dividend investing when I started, and then found my footing elsewhere. And Ryan, you're still dividend investing, and I just want to make the point that I think, I have such a privilege. Obviously, every week I'm talking live with Ryan, but then offline we talk, and Spencer, offline we talk. And I'm just sitting here now, and I'm like, I hope everybody out there has friends as diverse as we have here.
Definitely, definitely. And it's hard. I don't know about you guys. Growing up, none of my like childhood friends are really interested in investing. You have kind of the wave where one will get really into crypto for a couple months and then they never talk about it again, stuff like that. But it really does make a huge difference having a community of people you can bounce ideas off of. And I am curious because I have shifted I'm about 50-50 dividends and growth. I like some growth ETFs. I think it's nice to have, kind of like a base of the NASDAQ, of the S&P, of the Russell, and then also throwing in some dividend stuff that we've talked about, on your podcast as well, Ari. But I've started using a little bit more leverage. Now, hear me out. Hear me out. It's
Oh,
not a lot.
man.
It's a small portion. I know. You guys may be more leverage averse, but there are some new funds that have
Spencer's
been coming out.
18x.
Yeah, that 5X fund that got blocked by the SEC, that was mine, actually.
He put up the Batmobile as collateral.
Yeah, crime fighting doesn't really pay the bills, and but yeah,
They said, who's this silky smooth guy?
Oh man, I'm
We're a
using a
mess
little
today.
more leverage with stuff. I really, and I'm curious on your guys' takes with. There's so many leveraged assets now. There's so many ETFs. I should start off with that because we see now there's more ETFs than stocks in the market. So for me, as a YouTuber that primarily focuses on ETFs, I'm like, sweet, unlimited content. But we've seen such a big shift. I do still hold a few single stocks, some dividend stocks, some growth. But it's just wild to me now that there's so many ETFs being created, and I can't even keep up because I really kind of honed in on weekly dividend ETFs, kind of my bread and butter content. And when I first started tracking them, there were 7. And I did a recap recently covering all of them, since inception. And now there's like well over, I think it's like 130, 150, something like that. And that number grows by the month now. They're creating so many more. So it makes it hard to track absolutely everything, but it's really interesting the dynamic we're seeing in the market and how there's so many new weekly payers. There's so many new ETFs in general. And I'm curious, has that impacted how you guys invest at all, or are you just honed in? I know Ryan's portfolio because I watch the updates all the time. So, but I'll let you guys, explain a little more onto that.
What do you think, Ari?
Oh man, I am a very dynamic investor. I think if someone were one of the questions on the Blossom tour actually, that was asked at every stop was, what type of investor are you? And when that question was posed to me, every time I had the opportunity to share it, I said, I no longer like to define myself as an X investor, so a dividend investor, a growth investor, an ETF investor, because I think that if you're a wise investor, let's call it that, if you're a wise investor, you're going to be dynamic, and you are going to be, adapting to the times and your goals. And so if your goals change, then your strategy may need to change. Maybe it doesn't. But maybe it does. And so I think I'm a dynamic investor. I am not going to sit here and say I will never put my hands on a leveraged fund. But there has to be, I think, a good reason, a time and a place, and I think a pretty I want to say audacious goal, but like I feel like I have, audacious goals already, but not quite enough for me to go in the leverage direction. Ryan, I feel like I know your answer, but now I want to see if I do know your answer. So how are you going to answer that?
Yeah, I mean, just as far as the number of ETFs, like covered call ETFs or weekly paying ETFs, whichever, as far as that goes, I would say that the more they've come out, the less interested I am in them. Just because, like you said, there are too many to keep up with. But at the same time, I don't think it's all too surprising that it is kind of going in this direction. Number one, that there are just a higher quantity of these types of funds. But number two, that kind of the goalposts keep moving. Because first it was like monthly paying, right? And that was, great. But then someone had to come out with the weekly paying, and that became, there's a positive reaction to that in the market. People would rather have weekly dividends than monthly. And so more and more funds either came out with that payment frequency or they even changed from monthly to weekly. And so I just, it's not all too surprising. I actually think the goalposts are going to continue moving. And this is something Ari and I have talked about a few different times on the podcast. I think it's been a while, actually. So maybe it's good we're bringing it up again. But I wouldn't be surprised if we start seeing like bi-weekly dividend payments coming next. Eventually, we might even already be there. I don't know.
That's already out there, man.
So, okay, well then with that said, I think, if it's not already here yet, we will see daily dividends coming out. But I think, generally speaking, if that's the fund's emphasis, if the fund is really emphasizing the payment frequency and investors are buying it because of that, I think you're totally missing the mark. And so I think that there's a lot of those coming out. Rightfully so, though, because that's where the demand and the interest is right now. So you can't blame the market for trying to deliver that, which is actually like a sentiment that I've really picked up from Ari, because I know that that's kind of his inside baseball, and it totally makes sense. But I've kind of tuned all of it out because it's just not really up my alley. And like I said, I physically can't keep up because there's new funds coming out every single day. But to close the book on this, kind of like Ari said, there may be a place in time in the future if my interest change, if the goals from my portfolio change, maybe someday I'll get into covered call ETFs or get back into covered call ETFs. But for now, it's just, I'm really interested in just finding companies that are interesting to me and kind of building a collection of those. That's really where my focus is at. But like Ari said, never say never.
I think an interesting question that might be even more interesting than if we would ever get invested into these types of ETFs is, did we all think that the market would be where it's at these days with these types of products? Like looking back, when I look back, even just to 2020, when I really started getting, into investing and started building out a dividend portfolio, I have to say, I never would have predicted the direction of ETFs and the sheer power that the market dominance, really over 4,000 ETFs out there now. I would have honestly, I remember I do still think that individual stock plays, at least for me, are golden opportunities. But ETFs have made everything simpler, which is what investors really want at the end of the day. Did either of you ever have thoughts about like where the industry was going and that we'd be here with Spencer's whole channel is ETFs, like that's wild to me.
It's really interesting, and it's been a shift. So I started investing, I think it was 2018, 2019, something like that. And when I first started, quarterly dividends was the norm, right? Maybe there were some monthlies, but it wasn't as popular and people didn't really seem to care. I remember when I talked to my dad, because my dad, he's an accountant and he's been doing accounting for 30, 35 years, something like that. He's phenomenal at it. He's incredibly risk averse. He is, not interested in single stocks or anything of that sort. And I told him when the weekly dividend ETFs came out, I was like, Dad, there is a way you can get paid weekly now. And he was like, scam, 100% scam. Like, it's not real. And it's so interesting how the dynamic of the market has shifted so much that original dividend investors were, dividend stockholders. They didn't have these ETFs. And so now you kind of almost have a mixed bag where you have dividend ETF investors and stock dividend investors as well. But what blows my mind, and I'm so curious as to your guys' opinions on this, I have a pretty decent size percentage of my audience that would rather have a weekly dividend over a monthly dividend, even if the weekly dividend underperforms the monthly. That's how much they want the income. And I'm curious as to your thoughts. Do you think it's because the economy's tough right now, everything's super expensive, like people need their money? I'm curious your thoughts.
Maybe that's part of it, yeah, but I think more than anything, it's a dopamine hit. Like the more
Yeah.
dividend payments you receive, the more you get that fix. And I totally understand it. Like, there's few things I love more than seeing those dividend payments come in. But at the end of the day, like I always go back to, it doesn't matter what the payment frequency is, whether you're getting paid, a dollar per week, or I don't know what 52 divided by 12 is for the monthly payments, or you're getting, 52 divided by 4 for the quarterly payments, or just an annual payment of $52 in dividends. The number all works out to be the same. The payment frequency it might make you feel good. It might give you that dopamine hit, but it really doesn't mean anything in the grand scheme of things. And I think that I just really don't think that should be at all part of your criteria when selecting an investment. And I think, like, if it all works out to be the same in the end, then it's really just a matter of budgeting that
Hmm.
money comes in and when it goes out. I think that's probably the more important thing. But what do you think, Ari?
Yeah, I like to say, Ryan, as you know, dividend dopamine. And it's a very powerful drug. It's arguably the most powerful drug the market has to offer. Dividend dopamine. And guys like Spencer are the dealer. No.
It kind of seems that way sometimes.
um, no, the reality is, I think, like Ryan just shared, it doesn't matter the payment frequency. And now here's what's going to matter. Are you at the end of the year, have you made money or did you lose money? And so if you were receiving dividends on a weekly or a daily, heck, hourly basis, I feel like, it's not crazy maybe for some Looney Tune firm to come out with. Um, People are going to want that because they simply they haven't read the prospectus. They don't understand really what they're investing into. That's all they see is money came in. They have no idea if it was just simply even like return of capital. They don't even care. I think they just like to see the hit. And that's why I call it dividend dopamine. And I think there is a big difference between an investor and a gambler. An investor and like, just it's like, it reminds me of like, some of these firms that are out there, it's like car salesmen, right? Like you immediately hear car salesman, you're like, and I just feel that the industry as a whole can do a lot better on informing investors with big, bold print, like now we can only do so much. I think that's the other reality of this picture. We can change font sizes. We can put bold lettering. But is the investor going to do their due diligence? And I think there's another problem, if I don't say so here myself, because we're all creators. I think the creator economy has also destroyed a little bit of the realities that we are facing, because it's a really sexy title to say monthly income, daily income, 87% yield, money in your pocket, quit your job tomorrow. But then you start to invest in it, and Spencer, you know way better than Ryan and I what some of these funds are capable of or not capable of. So, I mean, what's your honest take, man? Like, what's your honest take on, I'm going to go twofold here, on young investors investing in the covered call funds to quit their jobs and retire early, like ASAP, and the funds with like the crazy yields above 20%. I mean, I feel like anything above 20 is really ridiculous.
Definitely. And it's so interesting. I think it's a double-edged sword because at one point I'm happy that we have a lot of new investors. I'm happy that younger
Yeah.
people are thinking about their futures long term, because that's why I started my channel, was like, hey guys, we need to use time. We have to use time, to really retire early, or even retire, where you have enough money to live off of. But the problem with that is you get a lot of inexperience. And I was there. I've been the guy that was following traders on YouTube, tracking what they were doing and copying it. And it didn't blow up my account because I only had a couple $1,000s. So it wasn't like a destruction of my financial life, but it really was terrible because I was like, wow, like, I lost money on this. I wasn't really doing my own due diligence other than just watching people on YouTube talk about it. And with that, you have bias, of course, because that's one thing I really wish that viewers on YouTube understood, is you have to be careful who you're watching. Because are they in it because they're holding the underlying? Are they interested in the topic, or are they interested in getting views and clicks? And it's hard to stop yourself sometimes, where it's like, oh, this thing is blowing up, but like I don't want to make only content on that. And we saw that with these crazy yields, right? So I saw a bunch of YouTube channels created just on one specific asset that was supposedly distributing 90%. And when that asset tanked within the last 4 months, 3-4 months, those channels have been deleted completely. Some of them haven't posted since. And it's really interesting because you do get kind of pulled into that idea of, you know what, I can retire 10 years earlier if I can maintain this rate. But what my main point with this is I think total return is the largest factor. And so we've kind of coined this term NAV erosion. As things over time, your NAV decays, your original investment goes down, and you're kind of getting paid your own money back through these insanely high distributions. But for me, I don't like watching my initial investment. I'm still a growth investor, a value investor to an extent. And overall, I don't want to see a bunch of red in my portfolio, even if I am in the green. And that's what we've seen with a lot of the weekly dividends. Is some of them, I mean, it's amazing. They're up 22%, but your initial investment is down 36%. And so it's hard. It's hard to kind of track that. But I worry for a lot of, newer investors that are joining the investing game thinking that they can double their money in a year because this thing's going to pay me 90% every single year. And I worry about the fact that we've seen so many of those ETFs grow in popularity rapidly and then fall off. And it's really like, who's left holding those losses? It's primarily retail. I doubt we're getting a lot of institutional investors, in these, a lot of buy and hold investors in these ETFs. So that's the thing. I do think that there is a time and place if you want to put some fun money into those things, not financial advice, of course, and just, see what happens. Sometimes I think people misunderstand these ETFs and they don't realize the impact that the underlying performance of these stocks is going to have, especially on these like 2x, 3x leveraged funds. You have to really believe in the underlying. You can't just think it's going to continue to pay out 80% for 30 years, and become larger than the entire market cap, just one ETF. So I think that there's a lot of learning that needs to be done for newer investors and for people to understand that these are extremely high risk. And I'll give an example. I've talked about these high risk assets before, and in every video I say these are extremely high risk. I'm never going to sugarcoat it. I like to be open, like, hey, these things are crazy. Yeah, the performance is up 40% in 5 months, but it's still super high risk, right? The minute something falls off, people, lose interest in it, so on and so forth. People will come back and say, oh, you're not talking about this as much. You were hyping it up. And I'm like, well, I told you every single video, these are high risk assets, but the other, side of that is if I don't make content on it, people ask me about it all the time. So it's hard as a YouTuber to kind of showcase like these are high risk assets. We have to be careful. This is our money, right? It might just be a couple $1,000s in a multi-billion-dollar fund, but to us, it means a lot more, especially if, you're trying to save up, if you're younger, and so on and so forth. So it's a long-winded way of saying, yeah, we have to do our own research, but I do think that there is almost like they're taking advantage of some investors when it comes to these insanely high distributing funds.
Yeah, that's a great point. And as a creator too, it's in the same way that we, do in our portfolios, you also have to take a long-term approach because like you said, it's easy enough to make a video about the hot fund now that's delivering that 90% yield. And then it's easy enough to just not talk about it anymore when it suddenly crashes. And in a lot of cases, that kind of stuff has become a money grab, and I think it's kind of become apparent over time.
Ryan's early 30s. I'm early 30s. You're late 20s. Now, you, Spencer, are invested in some of these types of funds. So, and Ryan and I aren't. I mean, I'm, yes, I do have ETFs in my portfolio, but then I also have individual plays. Ryan's predominantly individual stocks. So for these young investors, I mean, honestly, I know it's not financial advice, but would you recommend that these young investors go in this direction? I feel like we're totally missing the boat when it comes to these younger investors and kind of guiding them in a good, safer direction.
Definitely. It's a phenomenal question. And so my take on it, and I'll tell you what I'm interested in. So I like the leverage funds. When it comes to the weekly payers, my portfolio is probably half dividend, half growth at this point. Maybe even a little more growth as things have kind of taken off. The dividend
like some of your, sorry to cut you off, Spencer,
no,
but just for context, like some of your bigger holdings are actually just SPY and QQQM, right? Those are like two. I'm looking at your portfolio right now. Those are two of the larger positions that you have. Sorry, just wanted to add that context.
No, that is good context. Yes, and then like Main Street Capital is a dividend stock that I've held for 2+ years that I love. I hold some energy plays. Yeah, so I do. I have a really mixed bag where it is funny, Ari, like when people ask me what kind of investor are you, I'm like, I'm a little bit of everything, right?
I'm a silky smooth mixed bag.
Silky smooth Batman investor. Yeah, so it is. I think that long term, that is what's right for me. I think that will hold my portfolio up. I'll track the market relatively well. There's a lot of overlap between the NASDAQ and the S&P 500. So, maybe I'm not diversified enough. That's why I do have some other plays in there, and I'm working into some different, sectors, kind of some AI-focused sectors that aren't directly in AI, like NUKZ and a couple of others. But so just some growth ETFs. But what I think is really interesting, though, with these weekly payers is I'm not interested in all of them. I'm only interested in ones that meet my personal criteria for what I want to invest in. And so there are some that are like a 1.2x. We have some new ones coming out that are a 1.3x, and they all employ different strategies. We have a mix where some employ half leverage, half income. And so what I like to do and what I do on the channel is I track the performance, and I'll pit them against each other, and we'll see exactly which ones are the best, what strategy is working, and what was the underlying doing during that time period that made this strategy better than this one. Like, why were options better than just swaps and leverage? And so with my actual own investment portfolio, and I'm doing this, it's kind of crazy. I'm not doing it just for YouTube, but I've picked 10 or 12 of these weekly payers, and I'm putting $500 into each of them. I'm going to track their progress. But my criteria for it was, these are things that I want to hold. So I used to do it. I would just have YouTube vote on it. And I was like, there's too much money into it now where like I can't just take like a 50% loss because everyone wants one fund that's tanking or, something along those lines. But the underlying is key. Do I think in a year it's going to be in the green? Do I think in 5 years? Do I think 10 years? And so I really have to research these companies a lot in my off time and understand why I believe long-term it will be in the green. Because if I'm employing leverage, you just have more risk there. And so, I think weeklies are probably 20 to 30% of my portfolio, maybe even a little bit less than that, depending on, I haven't put all the money in from that new challenge yet, so it will be more. But when it comes to a new investor, you have to understand the underlying is super important and the strategists behind the options. If you're utilizing an option fund, we've seen some funds absolutely launch and then absolutely tank. And it all depends, like, what's the market doing? What are the underlyings doing? How's the performance? And why? What was the shift that switched? And there are some really good YouTubers that actually will track the options. Brad, Income Architect, phenomenal guy. He's on, we have a podcast now, which has been super fun, learning from him. But he will go through and literally look at the options they're writing, see how much money they're making, and give that information out, which is absolutely amazing. Channels like that I do think are really, really valuable, but I think it's important to understand, or at least have a basic understanding of options if you're going to be diving into some of these ETFs. Now, that being said, there are some 2x, some 3x weeklies, and those I'm not interested in. It's just too risky for my personal risk amount. So I like a little leverage, maybe a 1.2. I would probably go all the way up to a 1.5 if I really believed in the underlying, but that's pretty rare, and I haven't done it yet. So maybe time will come where that makes more sense for me. But right now, yeah, I'm definitely happy with a little more risk. And that for my wife though, I invest for her as well in her Roth, and we just do all growth because I buy it and forget it. I don't want to have to track. And I think that that's something that's different than, in this market that we've seen is with these weekly payers, you never really know. One thing of bad news can come out for the underlying and it tanks it. Coinbase stock had bad earnings, right? And so all the Coinbase weekly ETFs absolutely tanked. And so you really do have to be an active investor. This is not a passive form of investing in most cases with these weekly payers.
So I feel like I have so many thoughts, and you kind of answered the question that I was trying to transition into a few minutes ago when I totally butchered that. But I was going to ask, so in looking at all these different funds, what are you looking for to help discern whether it's potentially a good fund or a subpar fund? But you kind of answered that already. It's basically just the underlying, number one, but number two, the strategy, the option strategy or the derivative strategy behind it. It's just pretty much those two things, right?
Definitely. And I think it's important that we realize, as option-based investors, even though I'm partially option-based, strategists can make mistakes. We can see things shift where they technically could just be lucky for a certain period of time, and then all of a sudden things change, And so that's why you do have to stay on top of these options and try to understand, if something did shift, what was it, and if you can avoid it in the future, to try to do that and just learn from all the mistakes.
It's so funny. I was going to bring this up too, and I might butcher this again, so I apologize in advance. But as you were talking, I was thinking, it's really interesting because people get into dividend investing and investing in these high yield covered call ETFs or derivative based funds. That gets lumped into dividend investing, understandably so. Whether that's right or wrong, because I know dividends versus distribution, there's a whole thing. But it all gets lumped together. And with this style of investing or with this approach, a more cash flow based approach, you are, the goal is to be a buy and hold investor. You're buying things with the intent to hold them for a long period of time and just collect the income. And because these buying and doing that with Procter & Gamble and Coca-Cola or Microsoft or whatever, because that also gets lumped in with, the weekly payers or the yield max funds or whatever, I think investors, especially new investors, tend to come into those type of funds with that same expectation, which is good. I think it's good that their intent is to buy and hold these things for a long period of time. But maybe that's where, let me know what you think, but maybe that's where a lot of this trouble is coming from, is because these investors are buying thinking that this is going to be their vehicle for long-term retirement. But you're over here saying, no, that's not the case. You actually need to stay on top of these pretty much every day, because actually, like Ari has said before, these things tend to reset every single day because they're continually writing, new contracts. And so I think that there's a bit of a disconnect here, right?
Definitely. And I think you hit the nail on the head with that too, is what blows my mind. Because the yield for my dividend stocks ranges. Like the lowest one's about 5%. If I ever came on my channel and was like, here's a phenomenal, dividend passive income asset, yields 5%, I would get hate comments.
It's too low?
Yeah, corrective comments, this is too low. There's no way.
It's so funny.
Because we're used to a world where you can range from, 20 to 100, right? 149, I think, is the highest I've ever seen. And so that's the thing. And the funny thing is, there's such a mixed bag of people who are investing in those, because you have one group of the younger investors that want the money to come out, that are maybe don't have a lot of experience with dividend assets, that are either living off of it or trying to live off of it. And then you have the other side where it's people in retirement that are like, I can retire early. And I've seen these people I retired early I just bought a bunch of yield max funds and look, now I'm retired. And it's oh boy, that terrifies me for that individual investor. Because you just never know what's going to happen. These funds, we haven't seen these funds survive any sort of a recession, even a real light one. I mean, we had late March, early April, there was a pullback, right? And the sky is falling, but that was nothing. I really got into trading stocks, buying and selling post-pandemic. And that was, I remember I had probably a $8,000 or $9,000 account at the time. And I would see swings. I had one day, I think I screenshot it. I made $3,500 in one day. and it wasn't day trading. I was buy and hold, right? And then there was a stint where it dropped $4,000 the next week. And so that kind of volatility, when you go into, these new style of funds, they've never had to withstand something like that, not even close. And that's what horrifies me, because you never know what the market's going to do. Yes, we can, hope it's going to be green. And I do believe the market long term is going to, trail up and to the right. But you have to have that understanding. And I'm big on diversification. I don't think you should ever put, all your eggs in one basket. But to circle back, Ryan, to what you were saying, I think it's hard because the distribution and a dividend are vastly different. Distributions are controlled, right? The company decides how much to pay out. And so that's one of the biggest things, was people shifting from dividend investing to distribution investing, even though we do kind of call all of them dividends, which isn't technically accurate.
There's symmetry, right? There's obviously symmetry, but
yes. Yeah. So what the dividends are based off of profits of a company paid out, or depending on how much they have to pay out, if, they're a REIT, BDCs, things of that sort. But the distributions, they have control. So they can pay out more as, even like a return of capital. You can get a really high distribution rate and there's no issue with that. Whereas a dividend is based off of what the company's doing. So you could have, for instance, you could have a company paying out an 80% distribution rate that's not even making money. They're just paying you out, right? They're just paying back original investors' money. And that's the same thing with dividend investing. I love dividend stocks. My starter point with dividends was I found a few that, like Realty Income has outperformed the S&P when you backdate it all the way back to the beginning with DRIP reinvested. And that was what really got me interested. I can outperform the indices with dividends. Compounding is my friend, over 30 years. I'm so young, I can use that compounding really to my advantage. But when you come to these crazy NAV erosion ETFs, you have to drip just to maintain, because all of a sudden you're getting, the yields maintained, but the NAV is just falling over time, and they're trying to prop it up, reverse splits, all these different things. And so that's the hard part. It is a combination of two worlds. Dividend investors and dividend ETF investors, I do feel are different. And I'm curious what you guys think. I want to throw the ball back to you guys, because I've seen a crazy shift, not only in my content and views, but in comments and watching other people's videos on these income ETFs. We're seeing a crazy shift from the high yield to the, I call it mid yield, 10 to 20%. And I feel like that mid yield is kind of exploding right now as a pullback, as a reactionary response to what happened primarily with Yield Max, as we've seen a lot of their popular funds falling. And I'm curious what you guys have seen along those lines.
I think right on the money with what you shared, Spencer. I think at this point in time, we've now been able to experience the fun, the thrill, the excitement, the dope, right, of the last year, the last year or so, of these 80%, crazy 149% ridiculous, right, yields. And I think at this point, so many investors have gotten burned by some of these crazy yielding funds that they themselves have dialed it back. But I still don't think they dialed it back for the right reason. I think they're dialing it back because they're nervous about the higher yields. So their rationale is, well, I just won't go as high. I don't actually think they have changed or have done any sort of real due diligence. I still think it's very dangerous for those retail investors. I also think, both you and Ryan have thrown dividend investors and distribution. And I think the big problem here is that, like we've alluded to just a moment ago, it's been all lumped together. And now, Ryan, I'd be curious on your thoughts with this. But 5 years ago, and Spencer, you didn't. I would toss this your way too, but you didn't. I don't think you had your channel 5 years ago.
I didn't.
At that point, there was growth investors and then there's dividend investors. And now I feel like the key word is not dividend investor, it's income investor.
Mm-hmm.
And so we're almost glossing over the terminology of a dividend investor, and now it's all lumped as income. So if this investment's producing any sort of income, yeah, we'll call it a dividend. I think that's happening too on Wall Street, where we're not even on that Wall Street side correcting the terminology. Yeah, just let it slide. Yeah, it's all the same, right? And this is causing, I think, a huge problem for newer investors or just investors who are not experienced with income.
Yeah. I have so many thoughts. This is the problem, guys. You guys bring up too many good points, and then my mind starts going a million miles an hour, and then my mouth moves faster than my brain, and it all just falls. It all just falls apart. So I want to go back a little bit to something Spencer said, like, when you first got into it, you remember like realty income was like considered a high yield, 5%, 6%, depending on the price, whatever. When I first got into investing, when Ari and I first kind of came onto the scene on YouTube, that was very much the case. Like a high yield was 4%, 5%, 6% you were getting wild, but like 4% and above was like it. But nowadays, kind of like you were saying, the expectation has totally changed. And in a lot of ways, it's
pop in for just a hot second.
Yeah,
Do you remember? I think his name was Bruce Wang.
I love Bruce Wang.
And
I
so
loved
he
him.
Appeared off of YouTube, but he used to talk about realty income, and when he would be like, "It's a 5% yield," I'd be like, "Whoa!"
I know. I know.
It's monthly.
And it's so funny. Like, it's just so funny. And this, Ari, this kind of goes back to a question you asked earlier. Like, could you have predicted that the market would go this way or that the industry would go this way? It's like, no, I didn't think 5 years ago that we'd be in a world where like 8% is considered like a low yielding investment. And so it is. It's just crazy to see how these things go. But I will say, in terms of kind of seeing a pullback or maybe kind of the mid yield things, the 10 to 20% mid yield as far as like funds go, as far as that kind of becoming popular. I mean, I agree with Ari. It's really probably mostly be out of necessity and just realizing, oh, this other stuff is, the 80, 90, 100% yields. It's not gonna be sustainable long term. So I think it is out of necessity versus, actual more due diligence. I am totally talking out of my butt, and I don't know that for sure. And obviously, depends on the case or the person. It's a case by case thing. But I will say it's not a bad thing. I think when I'm looking at the funds that are typically in this range, now we're talking about the likes of like JEPI or JEPQ or SPYI, QQQI. Those kinds of funds, I think if you're going to be investing in these kinds of things, I think that's kind of where you need to be. I look at those funds and their strategies are a lot more straightforward than a lot of these much, much higher yielding funds. And yes, you have to know, either way, you have to know at least a little bit about options if you're going to get into this and understand the strategy, just like you'd have to understand a company and how it makes money if you're going to invest in that. So the same rules apply, but I think it's easier to wrap your arms around these more conservative strategies. And I think if a fund's just writing simple covered calls on like the S&P 500 or the NASDAQ or what have you, I think that's going to be much more sustainable long term, and those yields are probably going to be much more sustainable over a longer period of time than some of this other stuff that we've seen. And so, I don't necessarily have as much. I don't really have an issue with that. But then going back to, what Ari asked, like, should young investors be getting into this anyway? Or what's the deal with young investors getting into just these crazy high risk products? And there was even an article, you guys will remember this a few months ago. There was an article that came out in like Bloomberg or something that talked about like this new wave of, they even did it, this new wave of dividend investors. And it was all about, and there was that big, you guys will remember this, Ari, we talked about it. There was the picture with everyone standing in front of the New York Stock Exchange. Spencer, were you even there? Were you even in that picture?
I was there, and
Spencer
I was featured in the article.
Selfie taker.
Okay.
Yeah.
So you guys, so you definitely know this then. So, that article talks all about that. And, I've been thinking, and I read an article on this a couple days ago. I've been thinking, what is it really that's drawing young people? I kind of get it with retirees, but like, maybe it's the same with retirees as young people, but what is drawing people to these funds? And this article, just for some added context, and I'll let you guys loose with it. I read this article last night or 2 nights ago that kind of talked about a lot of this stuff. Generally speaking, younger people are foregoing the slow and steady, the traditional route to investing, and they are really leaning into high risk. I'll use investments in air quotes because it extends beyond investments. It's not just stock market. That's part of it. But they treat it like the casino in more ways than one. And it extends beyond that to now prediction markets that are on the rise, sports betting, these other things that are high risk, but are all attempts to like hit the lotto and get these big payouts in a short amount of time. In this article, they said that the reason for that, or one of the big reasons, is because young investors are kind of losing faith in the idea of, delayed gratification. They're losing faith in that being successful. You work a job, you stay there for 20 years, then you retire, you can buy the house, afford to buy the house, then you can retire. If you do the right things, you'll be rewarded for it. They're losing faith in that idea. And so they're now kind of feeling like at large, they have to try and take the shortcut in the hopes that they can win it big, because that's the only way they can actually get ahead in life or get the white picket fence or live the quote unquote American dream. What do you guys think about that idea? Is that mistaken? Is that spot on, Spencer? I mean, you're not too much younger than Ari and myself, but a few years younger. Is that something you see amongst, your peer group as well? Or where do you guys sit with all of this?
It's such a good question. I'll give you guys a little bit of an inside scoop. So I was at the event. I think I'm in the photo, and I was actually interviewed a few weeks after the event by Bloomberg. And they were super kind. It was really interesting, though, because I wasn't married at the time. We were planning our wedding. And weddings, for those that don't know, are super expensive. We had 170 guests.
Holy cannoli, Spencer.
It was a lot. My wife is Brazilian.
Should have done a Vegas wedding, man.
Yeah. So it was a lot. But I was really interested because at that time, I don't even remember what the channel was at. 18,000 subscribers, something like that. And they were interviewing me. And she was like, oh, like, what do you use your dividends for? And I was like, oh, like, I reinvest everything. Like, I'm not living on the income. She's like, oh, man, like, are you using it to pay for anything for the wedding or anything like that? And I was like, no, like, I completely reinvest. And again, they were really polite. There was nothing wrong with the way that they phrased these questions or anything like that. But they were looking for an answer as if I was using the dividends to live off of. And I don't know if they're working that narrative. I don't know if that's kind of the idea that they were trying to push with the article, that like, oh, younger investors are investing in dividends and distributions in order to survive. I don't know what the whole idea was. To be honest, I didn't read the article because I had to pay for it. And I was like, like I was only in it for a portion. But I thought that was really, really interesting. And to answer another part of your question, Ryan, I've seen, we all have, working in this space, creators. I think creators are drastically shifting the market. We've seen funds like SPMO. We have momentum, and momentum now overrides value. Because if you get enough people investing in something, even if it's not a profitable company, if it has crazy debt on its balance sheet, but you get enough people invested, it will go crazy. And maybe this has spurred off of the GameStop run, where retail kind of, took over for a bit there, and now I don't know. Who knows? But really, I think that a lot of it does come down to content creators. Because if you have someone on Instagram talk about a stock, a penny stock or something like that, and it goes up 5 or 6%, if they have a big enough following, they can literally move the market. And that, again, to go back to why I started my channel, I'll say I followed a channel called Moon Market, and he talked solely penny stocks. And I was so interested in that quick return, right? Because who doesn't want to, I was living at home with my parents. Like, if I could come to them and say, oh, I made $10,000 in the stock market on these, like, I can start to do this consistently and so on and so forth. Like, that'd be amazing. That's like every kid's dream for the most part, right? But I realized there was a trend where the stocks that he would talk about would all go parabolic, right? 30, 40, 60%. And then in the next 5 days drop. And it always blew my mind because I was like, wow, like I'm getting into these too late, blah, blah, blah. But I realized they were making money off of this. And so what they would do is, and I don't know the legalities behind it, they had a private group that would get the information early. Then they'd put out a video. You have a YouTube channel with 100,000+ subscribers. You put out a video on a penny stock, it goes 10, 20%, but your private group has already bought in prior to that. It goes crazy. They make all this money. And then what you do is you funnel people back to your private group and say, this is the real way you'll actually make enough money, where the rest is just off of the clicks and bag holding of people that don't really understand what's happening. And we have that today. Like, it's still really common, I would say, where you have investors who have channels fully dedicated to these weekly ETFs, these high, distributing ETFs that don't even hold them. It's not any part of how they invest, but guess what? They make money because it gets clicks. And that's what I would recommend people understand. You need to do due diligence not only on the stocks, but on the creators talking about them. See if this is what they actually invest in. And that's the beauty of something like Blossom. You can go look. But I can't stand when I see someone making 3, 4, 10 videos on something and they don't have any interest in holding it. There's no skin in the game. You have to understand that they don't care what happens to it, right? It's a point of views and income at that point. And I'm curious what you guys think, because you guys have been in the space even longer than I am, and you've probably seen a lot of these things take place.
What do you think, Ari?
I'll chime in, Ryan, to your question just before tapping into Spencer's question and just sharing that, I think what's most important is not getting too soft. And I think that society as a whole has been getting softer. And I can really go in on this one, but I'll play nicely in this episode. I see things today. I don't want to get political, but I do want to say this. No one's having any real conversations anymore. That's a problem. And that's a problem because God forbid you say even what I just said, right? That there's an entitlement problem, and I think the younger generation is getting soft, and I think there's a massive entitlement problem, and I think everybody's trying to base their life off of a pipe dream, and I think that's being exploited by much smarter people. Wall Street, much smarter people than these younger kids. I just want to say, just as an example, okay, I used to live in New York City, and what someone ran on recently in the city to win elections there, coming from someone who ran asset management on properties, most of that stuff is not possible. Mm-hmm. Just based off of the city's deficits and like it's just all the financing. But when you run off of free, and when you run off of you can retire early, and you run off of these pipe dreams, it strikes emotional chords off of really soft individuals. I am terrified of someone who's going to tell me, Ari, just invest in these funds. You can retire early. Invest in these funds. It's going to pay you back the income that you're making off your career. This is going to be free. I mean, if it sounds too good to be true, it usually is. But I think the younger generation is getting duped. I think we have completely lost our way from older generations, my grandparents' generation, my father's generation, and just think about this, right? Like I when I was working at a startup not too long ago, one of the last individuals that I interviewed showed up on the screen wearing a t-shirt, and I'm looking and I'm like, my man, you don't have the job. You're not Steve Jobs. And so he didn't get the job. But I bring that up because there's a problem, I think. And this all ties in now to investing, because what young investors are being sold on is the pipe dream that you can retire early. That's all it takes. Just take your hard-earned paycheck, if you're even making a hard-earned paycheck. Because I feel a lot today, there's a lot more complaining than there is working. But for those who are really working hard, now they're getting duped yet again, because it's, hey, just throw all your money into these funds and you are going to be able to succeed and retire early. So really, Ron, I think what we're facing these days is something much bigger than just this investment issue with these funds. I think we're facing softer and softer generations that are not working as hard but expecting more. I mean, this is crazy. This is nuts to me. The way I live is work hard, invest way harder, and then enjoy. I don't want to say play harder, because that's ridiculous. I think that's stupid. That's idiotic. enjoy. You can enjoy. But this like party hard, retire early, do nothing. I've even seen on Blossom when I've asked individuals who are investing into these funds. I said I wasn't going to get too mean. I guess I'm really going in on it. But but sometimes I ask people like, "Hey, why do you want to retire early?" Like, and they're young, right? They're in their early 20s. I don't know. I just don't want to work. What are you doing with your life? Like, what do you think? It's so bad. Spencer, he left. The guy left. That's how hard this is going.
I lost my camera. Oh,
Yeah, Spencer just.
I don't know what happened. Okay, wait, hold
Man,
on.
I didn't mean to be that intimidating, but but that I think that's a big issue, and I think it should be addressed. I don't know. I'll end that rant there, and Spencer, what was your question? Because I really just went off on Ryan's.
I'm trying to see. I think my camera overheated. Oh well.
I brought
All right.
too much heat, man. Too much heat.
Too much heat.
Cool
much
it
heat.
down.
No.
I need some armor.
I was curious what you guys thought of the YouTube space, the social media
Yes.
space, how that's impacting things and how people are getting rich off of giving financial advice. That's a whole nother thing. We can get to that another point, is literally giving financial advice and charging for it in the YouTube space is one of my biggest pet peeves. But yeah, your guys' opinions on that and how it's changed over the last couple of years.
So at least I'll go quicker on this one. I think that if a creator doesn't have skin in the game and they're hyping up stocks, you're following the wrong creator. Absolutely following the wrong creator. This is not to say, like, sometimes Warren Buffett, when he was running Berkshire, right, would come out and say like, "Hey, this is an interesting opportunity," but he wouldn't actively promote it. And so I think it's okay for creators, like sometimes, Ryan, I think you're still coming out with these types of videos where you're saying, "Hey, these are good ideas."
Yeah.
And I think that's fine. I don't think you need to invest in absolutely everything that you talk about, but you need to preface with what you're doing with it. Hey, I don't have any skin in the game with it. I'm not an investor in this, but I've been looking into it. Or it's an interesting idea that someone with this type of profile might want to look into. I've since stopped creating videos around, the best stocks to buy now or all that jazz. And I've just taken, a liking to my podcast and having genuine conversations. But I think it is, as this creator economy grows, as more and more retail investors flock to us creators, hopefully to shed some insights on product that's out there, I really do think we should have more fiduciary responsibility to at least give the retail investors, at least at bare minimum, some context versus just pumping up stocks because the ticker symbol is going to get them more clicks. Very dangerous waters. And I think if anybody is being paid for anything and they don't have a license, I mean, look, coaches, run. If someone does not has passed, I have passed, like these are exams you take. And if you don't have the proper registration, run from that person because they don't care about you. A lot of people in the industry probably don't care a whole lot, but they care a little bit more, I would say, than the creator who's trying to create the clickbait type of content. And that's all over the board. TikTok, YouTube, Instagram. Like, I just sit back on it. Well, who is this guy, right? What's he really saying? What's his angle? Why does he want so badly, right, for these stocks or something here to happen? What's the angle? What do you think, Ryan?
Yeah, I agree with some of that. I think, I think when it comes to talking about, because you're right, every month I'll make like a 3 deeply discounted stocks for, January or February, whatever.
Those are some of my favorite videos, by the way, not to interrupt. I love those ones.
Well, thank you, man. I appreciate that. I enjoy making those videos too. And I agree. Well, obviously I'm biased because I make those videos. Obviously, I don't own every single stock that I talk about in those videos, but my rule of thumb, and this applies across my channel, I will never like knowingly talk about a stock. I will never talk about a stock that I knowingly can say is like a bad investment. It's a garbage stock. Like I would never try and, back in the day, I would never try and prop up like, well, maybe at one point I did because I actually thought it, but knowing what I know now, I would never prop up Walgreens as a good investment or something like that. You know what I'm saying? Or talk about yield traps or whatever in a good light. If I think something's a bad investment, I'm never going to talk about it in a positive light and try and sell you on it. The things that the tickers that I include in my videos are ones that I actually think have some merit as a good investment. Now, not every single one has a place in my portfolio, but I'm only one person and everyone's situation is different. But at least here's an idea that has some investment merit. The financials look pretty sound, and maybe it's worth checking out. That's kind of where I settle on that whole thing. I also, to your point, Ari, I don't know that, in Spencer as well, I don't know that I like the idea of paid coaching. I think, yeah, if someone's like a CFA or a financial planner, or there's even, once you take the series, not series 7, there's one before that, right? That maybe it's the SIE. I think once you take the SIE, I think you could become there's something that you can get that's not quite a financial planner, or you can buy and sell stocks on someone's behalf, but you can be read. It's almost like a personal trainer for investing, and that basically you can give, like, I think, general budgeting advice and like very general info. I think that's fine, but even myself, like, I've thought, I don't have these certifications. I think that I probably could, if someone came to me and wanted some like actual advice, I could probably generally steer them in the right direction. But still, it leaves a bad taste in my mouth charging someone for that, because at the end of the day, like, I'm just I don't know, maybe I'm either hyping myself up too much or selling myself short. I'm just a dude in a room talking about stocks in his sweatpants. Like, I'm really like, and I just kind of want to share what I'm doing and don't really want to be responsible for what you're doing. I don't want to tell you what to do in your portfolio. I think that's your responsibility. And I think if you're going to be embarking on this journey and buying individual companies, like, you need to do so at your own discretion. Like, those are your decisions. And like I said, I don't want to be responsible for that. And if I don't want that responsibility, I'm certainly not going to like go out and charge someone for that information, if that makes sense.
I've seen, and I'm curious if you guys have had this too, some of these events I've gone to, creators are pretty open that it's just a moneymaker for them. Like, I've had guys say, oh, what do you guys charge for one-on-one coaching? I charge $300. They don't have any of the certifications. They're not legally allowed to be doing any of this. And then they'll literally be like, oh yeah, people just want to talk. They'll ask me, which of these 2 funds should I buy? And I'm like, there's so much that goes into, someone's decision with what they're buying, their income, what their goal. There's so much background that you'd need to give real advice. And I'm huge on not doing any of that. And so it does kind of blow my mind, where I'm like, I wonder if, like, your coaching clients or whatever you want to call them, if they heard you talk like that about them, what they would actually think, because it is just a crazy money grab. And we've all been approached by it. I have guys in my DMs all the time. I can scale you to 10 to 30K a month in coaching. And it's like, no, that's literally the opposite of why I created the channel, right? So it does kind of blow my mind. And I really feel bad for people that get kind of sucked into that, thinking a YouTuber, and I have the same mindset as you, Ryan. I'm like, I buy and sell stocks. I research it in my home office, and that's it, right? I'm not even part of the industry, really. And you want to come to me and ask me what you should buy? Like, that kind of blows my mind. But I do. I feel bad for the victims of those.
Well, it's interesting. Oh, go ahead, Ari. Sorry, man.
I was going to say, I think it's totally fine. Like, Ryan's content and Spencer, your content, I think it's totally fine. Because, like, Ryan, you being just a guy in a room wearing sweatpants, it's like, you're just a friend. And, like, Spencer, you guys have become just trusted friends, really, in these networks. Here's where it gets dicey. I will share a suggestion for payment, because now you are considered advising. And that's where fiduciary responsibilities come in, when you collect on that payment. And so, like, I don't have any issues with the best stocks to buy now type of
Yeah.
videos. Those are great, and some people really do. Shout out to BD Investing. I just read a comment earlier today where someone had posted on a thread of his, "Hey BD, like you've really helped me out on my journey. I'm seeing some returns from your ideas." And that's really great. And back when, I've had some of those comments too, and it feels great. But I've never collected a paycheck from that. And I think that's very important, because when you start to collect money as a coach, you do need certifications from that to do that. That's not legal activity. And I also have spoken with other creators, Spencer, to your point, and sometimes I'll look and I'm like, this person doesn't even know what like an option is.
Yep.
So if someone goes on your coaching call because you have a big following and they're asking for legitimate advice, one of the things that you have to initially do if you are going to advise people. Now, I am not a financial advisor, but one of the things a financial advisor has to do by law is determine the investor profile before they even offer a suggestion. And if they don't, they can be sued, because you have to have it's regulation BI, baby. BI, best interest of the person that you are giving the suggestion to. And so, a lot of these creators can be put in a huge legal hole if they don't go through that the right way with proper registration. And not only that, but again, the retail investor isn't armed with knowledge, and now the blind is leading the blind, really. And that's where it gets super dangerous. And I think it's different if you're a friend giving a suggestion or just investment talk. That's what we're doing here. None of us this episode have said, "Hey, everybody, buy this." Right?
Yeah.
We're like talking and having a good time, and it's all free.
Yeah,
But
I will.
the moment we collect payment, different story.
Yeah, that's a great point, and that's where the line can get crossed. I will say too, because I also do like portfolio review videos on my channel, which is maybe to some it can be kind of towing a certain line, but even in those, I try and keep it very general and above board. Like typically the things that I'm saying are like, oh, I see you have VOO and VTI and SPY. And it's like, so I'll say things such as, I don't think you need to have all three funds. And it's not just you specifically, it's the universal you. I don't think any individual needs to have three different S&P 500 funds and a total market fund. Or it's like,
you're not collecting payment for that, man.
No, not collecting payment
You're just
at all.
a massive bully when you do it.
Because it's all like the 16, 17-year-olds who want their portfolios reviewed, huh? Yeah.
Yep.
No, but that's kind of as in-depth as I'll go. It's very surface level. Like, hey, you don't, generally speaking, don't need to have three of the same funds. I think, stock over here is not the best investment because here are their financials, and that's just what I think. But I also like these things, so keep it up.
Yeah, if I had to do like a quick roast of Ryan doing one of these portfolio reviews, I'll sit and I'll stop scrolling and it's just to watch one, and Ryan will be like, "Look at it! Look at this guy! He's 14 years old with 18 positions, dude. Get off the playground! What are you doing?"
And there's typically a lot more F words too in that. Yeah, because that's totally
what
me.
An idiot! Like, why would you have 3% of your portfolio in this crap fund? The kid's like crying his eyes out, and Ryan's like, and another one bites the dust, baby. Takes a sip of Armor.
I will say the only one that I've actually felt bad about, I did a short video that was, the title of it was like the worst portfolio I've ever seen. And bless this kid's heart. I mean, I don't remember what the exact tickers were, but it was very concentrated in just really not great positions. It was something like maybe like two penny stocks or something like that, like super hyped up names. And then the third position was like a triple leveraged ETF. And that's where they were getting their diversification. But I made a video talking about how that was like the worst portfolio I've seen.
You
To their
probably
credit,
ended
though,
that kid's investment career, dude.
I mean, yeah, I think he posted some, like tagged me in a Blossom post after, and like showing his returns for a day where he was up like 3 or 4% and was like, oh, look at me now kind of thing. But you know, the point of it was like the outcome can be fine. Like you can be making money on this stuff in the short term, but like, dude, you're 19 years old. You don't need to be buying this stuff. And it's crazy. And this kind of ties back to some of the, some of the other things we've talked about in this conversation. It's just the things that some of these people are getting into is just beyond me. And I think that a more traditional way of investing, or having just a long-term mindset and being okay with the process taking a number of years or a couple of decades, I think that idea, to quote PPC Ian, is becoming kind of a lost art. It's kind of these days becoming more so the exception than the rule. And I think there's probably a few reasons for that. One of which is just that things over these last few years have just they've been really good in the market. I don't want to say it's been easy to make money, but it's certainly been a lot more good than bad. And so I think a lot of people kind of just getting into this stuff over the past couple of years, that's really kind of like you were saying earlier, Spencer, that's really all they know. And unfortunately, it is going to take getting punched in the mouth to kind of come back and swing back around to a more sustainable way of investing. But I think at the end of the day, I think it's going to be a net positive, because if this is what it took for people to start investing and it got them going and it got them on the path, then at the end of the day, kind of like, and Spencer, we've all had our own versions of this too, but like kind of like you were saying, getting into penny stocks when you were first getting going, losing, a couple $1,000s, that's kind of the cost of tuition. Mm-hmm. And, I think it's just, in the grand scheme of things, it's an important thing to go through. I think it's something that every investor has to go through. And it's just all part of it's just all part of the process. Couldn't talk there for a sec.
Ryan is usually, a really nice individual, but give him a portfolio of a 18 and under investor, and Ryan will set them straight so fast.
Someone has to.
Someone has to. Yeah. Everyone's got their buttons, and those just push mine. What can I say?
Oh yeah, I was gonna be under 18 years old.
That's it. Yeah. That's the rule.
I swear I saw someone who was like maybe like 11, or like they were really young, and I just started laughing hysterical because Ryan's like, "Look, I give this one credit. He's like 11." But wow, what an idiot. Look at this position. I'm like, oh my God.
You're making me look bad, man. I don't call people idiots, guys. If you go watch the videos, I've never called someone an idiot.
No, he doesn't call people idiots.
Maybe I've thought it, but I've certainly never said it. Never will.
That's what I hear in my head, man. When I watch your reactions, they're hysterical.
I think, what I think, Ari?
Ryan's breakdowns, you have to go and watch them. They're great.
I think you're hearing your own thoughts is what you're hearing. That's your own.
Probably.
Those are your own words.
Have you guys ever seen, on, I think it was SNL, it was like the Obama, the translator, the anger translator for Obama. That's what I feel like. Ryan's actually like, a lot of credit to this investor. He's 11 years old. I wouldn't really do this position. And really, it's my voice. It's like, what an idiot.
I want to go back, if you guys don't mind. I know we're about an hour 15 into it. It's going to be a long one today, guys. Longer, but I want to go back to something that Spencer was talking about, I don't know, maybe 10, 15 minutes ago now, talking about how, these days, and maybe this kind of ties into the whole lost art thing I was getting into, but, these days, momentum investing is really becoming the way to go about things. And or that's kind of what people are chasing now. And maybe these funds kicked it off. Maybe the good times in the market kicked that off. But I want to throw something out and get your guys' thoughts on this. I actually think that we've been in this stage for a long period of time where an increasing amount of investors, whether they know it or not, are actually just momentum investing. And I think this really started growing with the rise of passive investing. Because if you think about what it means to invest in the S&P 500, you're just investing passively in this asset, kind of without regard for, kind of like Spencer, you were saying, the financials of certain companies, or even the companies itself that you're investing into. You're just investing in this fund that's making all of these decisions for you, and regardless of the financial performance of the companies in it. I mean, even just the S&P 500, we can just stick with that. No matter what those companies are doing, more money is being funneled into those funds. And that is one thing that's continuing to push up and up and up the valuations of the companies in there. And I've seen whispers of this lately, but I think a lot of, and maybe they're biased in saying this, but a lot of active investors and a lot of active fund managers are kind of starting to call that out as a maybe potentially growing problem in the market, and something that's going to come and bite us in the butt later. What do you guys think about that? Does that even make sense, what I was saying?
It does. It does. I mean, I'm thinking off the top of my head, well, we have SPMO, and there's another fund by Vista Shares that just literally tracks like what people are talking about. There's more to that too, of course, like overall volume and whatnot. And it's just it kind of blows my mind, right? But it is, we're in a different world almost. And so like one example, like I trade Tesla all the time. It's one of my favorite stocks. It's probably one of my most profitable stocks. It's one of the only things I actually swing trade. And when you look at like normal metrics for value, like PE ratio, all of that is really out the door for Tesla. Same thing with like what Palantir right now. The PE was at one point like 600 or something like that, but yet it kept climbing. And so we're in a world where those metrics don't mean what they used to. And we have seen a shift from that value investing into, I don't know what we even want to call this. Yeah, hype momentum style.
Momentum investing, it really isn't, perhaps there's a new spin on it maybe, but really momentum investing, for what it really is by definition, is not a new concept. Again, I think it all depends on the market participants, and so with each new generation and how and also with each new generation comes different product. I think that's important to understand how now each generation is coming around and evolving, but also playing around with the products that are on the market shelves for them to buy and put forth in their portfolios. But look, when there is, Tesla is a great example. I don't remember a single day where anybody was like, well, Tesla's PE it's a great time to buy it, right? It was just like, no, Tesla for the win forever, right? Like
Yep.
Elon Musk is the PE ratio, right?
Mm-hmm.
Like, and so I think it totally is dependent on how people are feeling, really. But true momentum investing is equal really to the growth investing, right? When you're really growth investing, the PE ratio is naturally going to be higher.
Yeah.
And I think, again, that the terminology these days, and maybe it has a lot to do with a lot of the funds that are coming out and how they're packaged and sold, because we're really just throwing like a hodgepodge of definitions all in one bucket, right? Just like we did with distributions and dividends. Now it's just income. And then we can say, growth and momentum, and this is just, momentum, but we really have to, I think, define our terms and define them well and stick to the terms and not let new products and newer investors sway opinions on what definitions mean what.
Yeah, that makes sense. That makes sense.
But I do think,
guys,
I was just going to say this on top of that. I do think that with and again, I don't even want to say this is new, like investors not doing research. I think because of the ease of the ability to transact, it's taken away a lot of the art form of investing, because it used to be that you needed to go to your your advisor. You needed to have a conversation. You needed to place a phone call. But now you could just pick up your phone and within 5 seconds place a trade. That means that you're probably not doing a whole lot of research. We saw it happen in 2020. Everybody got government stimulus checks. And to the government's surprise, people blew that money on investing, which was awesome. But also, not everyone who spent the money in the market was a quote unquote investor. I would say 70% of them were gamblers, just hoping to make more. And so that it gets scarier as technology is making it easier. We are losing, as Ryan would say, this art form of investing. And I think overall, that's where now we're starting to see a crisscross in definitions. Look, I again, you can pull this out even from the world of investing. People like to be extreme with a lot of things these days. And so I think even at large, we're seeing a lot of definitions. At one point, a definition was like, hey, this is what that word means. And now people just arbitrarily throw words out there and they're like, this is that, right? And it's like,
Yeah.
What? No, it's not,
Well, it's funny, man. And I was going to bring this up earlier, so I'm glad this jogged my memory. You definitely see that in the dividend investing space because people talk about dividend investing and in a bad light, and it automatically becomes the people who yield chase. Like the people outside of this realm, dividend investing always equals yield chasing. There is no growth. And so when I, refer to myself as a dividend investor, there's a certain connotation that comes with that, but that's just a label, that within that can mean so many different things. And kind of like actually both of you guys, Spencer, you're even this too. You're known for investing in talking about income funds at least and in investing in them. But man, you have a lot of balance in your portfolio. Your bigger holdings are growth and foundational ETFs, and a couple of your other bigger holdings aren't even the funds that you talk the most about. It's like Main Street Capital Corporation and Ares Capital, and then you've got a handful of REITs and stuff in there as well. And so, yeah, I don't know. The whole label thing is interesting, and I think these are important conversations to have because there's a lot of assumptions that come with these labels that are not always correct, and it doesn't allow for nuance. Yeah.
I actually
times are changing,
Yeah.
and it's scary.
Yeah.
You better start swimming or you sink like a stone. Sorry. For the times they are changing. Sorry, go ahead, Spencer.
And with that...
Is that the outro? No.
Welcome to the Deep End Variety Hour, where we're singing, we're talking, and we are... I don't know what else we're doing. Go ahead, Spencer. What were you going to say, man? Sorry.
I was just going to say I created a separate YouTube channel to track
I was going to ask about that. Yeah.
Because I wanted more of a, I don't know. Some people say no, just do it all on the main channel, but I like having separate channels for like separate ideas for the most part, right? Like I talk growth ETFs and some of my single stock positions and whatnot on my other channel simply because it is a completely separate audience, right? And that's what I thought was interesting. I always figured people were like me. They had income assets, but also had a lot of growth. But there's a lot of just strict income asset followers that are not interested in anything growth related. And so it's really, there's just different markets. But I'm always curious too, Ryan, with what you get with the dividend side, because I get comments mostly on TikTok or Instagram, like bashing dividends and whatnot. And like, I always Main Street Capital is my go-to throw straight at them. Like I've seen huge YouTube channels bashing dividend focused stuff. And I just comment, I got in an argument actually with one of the creators at one point, which was really funny. And I said, well, like do a total return chart and put Realty Income, put Main Street Capital up against the S&P. And like, they never respond, right? Because if you do, at least last time I did it a couple, half a year ago, it was a pretty big disparity. Main Street with the dividends reinvested and the compounding outperformed. And that's what I do like, but I couldn't I don't know. I could put Main Street Capital on my main channel. I probably will put a video out about it at some point because it is currently, I think it is my largest holding. But when you mentioned, the growth positions in my portfolio, they are some of my larger holdings. Partially, the biggest reason for that is I bought in at a good time. And like the market's just been pretty hot for those because they do, rapidly grow. I think some of my best performers of my top 5, I think 2 of them are S&P funds from when I bought them, a while ago. So it is really interesting how I have to kind of slim down some of those positions and whatnot. But Yeah, I thought about that. I was like, yeah, you're right. Like it is. It's a big portion of the portfolio now because of the growth aspect. But the dividend side, dividend versus growth, I always go back and forth. I just love them both. I can't pick one. I genuinely can't.
Yeah, well, that's something that I've been having a hard time with, that whole like dichotomy, the dividends versus growth, especially like I actually watched a video on Instagram a couple days ago. I don't want to name the creator, and you see these all the time, like the videos like why young people shouldn't invest in dividend stocks, and it's just the same old stuff. Like the main
Dude, you talking about
argument.
me?
No, I'm not talking about you. The main argument that I see in all these videos is that the companies that pay dividends are not reinvesting in the business, in their businesses. And I hate that conversation. I really resent that conversation and that train of thought, because it sets it up as if it's like one or the other. Like the assumption in these videos, and what they're basically saying is the companies are not they're not putting any money back into the business because they're paying it all out on the dividend. But it's like, that's such a, excuse my French, but that's such a stupid thing to say. Because do you not think that these large multi-billion dollar companies are not like prioritizing their growth, and taking care of business first before paying the dividend? I hate that part of the conversation, because when it comes to, even like some of the bigger companies, or the bigger dividend payers, I should say, the real dividend stocks, like the Procter and Gamble's or Coca-Cola's or Altria Groups even.
Mm-hmm.
You really don't think that they're using money to continue trying to grow their businesses? It's like, come on. But the thing about a lot of those businesses is that they really don't require a lot of capital at the stage that they're in. And that's really what these creators are saying. Like, you shouldn't be investing in those businesses at that mature, slower growth stage, because you're younger and you need to be investing in assets that are growing their fundamentals faster. And the way that it's worded always bothers me. It's just a wording issue, really. And I think they mean well, but the frustrating thing is, like, it casts that opinion on dividend stocks. It's like, well, what is a dividend stock? Getting back to labels, what do you define as a dividend stock? Is it a stock that pays a dividend? Because I mean, that's gonna be a broad range of different kinds of companies that are in different stages of their life cycles, with different fundamental and financial profiles. Like Microsoft is a dividend stock, just in the same way that Main Street Capital Corporation is a dividend stock. And the fact that a stock pays a dividend doesn't mean that it's like subject to subpar returns forever. Like, just because it pays a dividend doesn't mean it's funny, because they'll say just because it pays a dividend doesn't mean it's a good investment. But the inverse of that is true. Just because it pays a dividend doesn't mean it's a bad investment. So I hate that this is even still a conversation. It's like, why just look at the business first and foremost. Look, if we're just talking individual companies, not funds, look at the business first. Like, no dividend investor, well, I shouldn't say no. Most dividend investors, most normal, rational people who invest in dividend stocks understand that you need to look at things holistically in the business. And it's been really frustrating seeing dividend investors painted as these like dumb people who are just buying things because it pays a certain yield, when in reality it's just not the case at all. And I'm sorry for the tangent, but it's that. All jokes aside, that really does push my buttons, because it's so lazy. To me, it's just so, it's such a lazy argument.
Well, Ryan, when I was transitioning my portfolio, and we had already started the deep end by this point in time, I took a lot of heat, man. I took a lot of heat, because I went from, my yields ranging in that like 2 to 4% window. And then I started to cut down to just dividend growth stocks. And my dividend growth stocks typically were underneath maybe the 1.5%, bar there. And like, someone called me out because I had Visa, and they're like, Visa's not a dividend stock. And I was like, yeah, well, actually it is, because it does pay a dividend. So I don't know what you're defining as a dividend stock, but well, maybe that's define a dividend stock by a dividend.
Yeah. Maybe that's part of the problem. Maybe dividend investors are just as bad in the other way, saying like, it can't be a dividend stock unless it has a certain yield. You know what I'm saying? So I think that's problematic too. The whole, just across the board, labeling is bad. It's bad.
Yeah, well, that's what I'm saying. We have to go by definition. Like, again, just to make this like a much larger issue, I don't know where it's come from. I don't know if people are no longer like reading history textbooks, and I don't know if people are, maybe they don't have their hands on, dictionaries or whatever today, but like words, I feel like today are just thrown around and no one even knows what they're talking about anymore, though. But that used to get, underneath my skin a little bit, because I would always preface my videos by saying like, hey, according to my investor profile and my goals, here's what I need to do. And it's cutting the yield down to go in a more growth oriented direction and dividend growth orientation. And people, I mean, wow, the comments, he's only using dividends in his titles because, it gets clicks. And I'm like, every stock when I made those videos paid dividends. So I don't know what you want from me. It's crazy to me. And I do think it's on both sides. And here's where I say, though, that defining yourself, I think, as an investor is also a bit of an issue. I think we should cap it as, I am an investor. I do what an investor does. I find companies that have value, that are hopefully they will grow well into the future, that I will invest money into. And like, enough with the wars between growth and dividend or income, or like, if all of us got together and just kind of said like, hey, we're all investors. Ryan's got some pretty interesting ideas over there. Spencer's got some interesting ideas over there. Ari's got some interesting ideas. What can I learn from all of them? Instead of saying, oh, Ryan's a dividend investor, Spencer's only into ETFs. Like, they don't know what they're doing. It's like, that guy's the guy who's in trouble. The guy who says nobody else knows what they're doing, but I have the way. You're the biggest loser in the room at that point.
I think anyone who says definitively don't invest in this stock, this type of stock, or that type of stock, well, within reason, there are some like objectively not good,
out there.
good things to put your money into. But when you say don't invest in growth stocks if you're this age, or don't invest in dividend stocks if you're under 30, it's like and saying saying that a whole subset of stocks is like a bad investment blanket statement. I just think that's so wrong. I think that's so wrong, because there's so much nuance and there's so many exceptions in any case.
For example, this is actually a really good point here, Ryan. Reg BI, though, I talked about it earlier. Regulation best interest. By the way, that's how creative people are in the financial industry. Regulation best interest. So, anyways, but when you look at that regulation, actually, one of the very first questions that your advisor should be asking you, or even your broker dealer, whoever you're dealing with to transact, they have to put together your investor profile. But one of the most important points of your investor profile, it's yes, age is a factor. Yes, your income is a factor, and your assets and liability, that's all a factor. But one of the biggest factors comes down to your risk tolerance. So if you are a 20-something investor, but let's say, your grandparents were from the Great Depression, your parents were divorced, and you just had a bad upbringing, financial traumas, and you now are approaching the market and you are terrified to get invested, well, your risk profile doesn't read growth funds at that point, or it doesn't read growth investments. Mm-hmm. It leads someone to say, hey, let's take a more prudent approach, because the risk factor, the last thing we want this individual doing is pulling their money from the market because of these volatile swings. So that is huge, and I think it's oftentimes overlooked. Just because someone's young, to your point, Ryan, it doesn't mean that their investor profile is all off because they're investing in certain types of stocks. You have to look at the full picture, not just the picture that you want to look at.
Yeah, couldn't have said it any better myself. And that's the problem. Usually when these conversations are had, the only part of the investor profile that's taken into consideration is the age. But it's like, son, you don't know me. You don't know my life. You don't know what it is all about. I'm confused. I don't know my
Man, oh man,
life.
dude. In this position over here.
Yeah, so I think that's it. I think really, really that's it. But, I don't think this, unfortunately, I don't think this conversation is going to change things. I think people are always going to bicker about whatever. And maybe it'll become even worse over time. We'll see what happens. But, yeah, it's
Well, you
interesting.
know what? I'll say this. I think we are, all three of us, if I don't say so myself, we are actually
Very silky
creating a
smooth.
pretty big impact. I just had someone on Masters of the Market the other day that this upcoming episode is going to drop on next Sunday. Just to give it just a little snippet of this individual story. He's an immigrant from Cuba who moved from Cuba to Canada, from Canada to the U.S. And I mean, the guy's been literally, he explains a story where like sometimes his parents didn't eat because they gave the food to the kids growing up in Cuba. So really just this hard upbringing, terrified of losing money, had a strong work ethic, but then got into the market, blew a lot of his money on penny stocks, didn't know what was going on. So you could just see this whole story kind of unfolding. And the reason why I'm sharing all of this is because Ryan, what he actually did share is that the deep end has actually really helped him on his journey. And I'm not now just, propping up the deep end. I'm here to say that any creator out there, Spencer included, who is sharing insightful information with good intent, if you have good intent and you are sharing insightful information, you're honest, we're all now like, yeah, we're having a good time on this conversation. But people are out there, they are learning from us. And so I think even if we change just one mind at a time, we're doing a major service to the entire world.
Dang, man. Mind blown. You're spot on. You're spot on. Because you never know, like, what ripple effect that's going to have.
Yeah, and by the way, his kids, he tells a story now of his daughter and his son. They're like 11 and 9, I believe. Now they're actively investing. And so
Nice.
it's just like it starts off with guys like us creating good content, insightful, having fun doing it, really looking to just give some help to those looking for, whatever it is that they're looking for. And whether it's entertainment in conjunction with insight. I mean, this is what we're in the business of really doing, and hopefully we do it well. So I do want to say with that, drop some comments down there to let us know how we are doing and what you thought of this episode, because it means a lot to us just to understand that we are executing on what we say that we'd like to think we're doing. So let us know what you thought about this episode. Let us know what you thought about Ryan. What did you call Spencer's silky?
I think I called him a silky smooth son of a gun.
I like that. I'm going to use that.
Let us know what you think
Please
about
do.
the silky smooth son of a gun down there in the comments. If we should have this guy back on, or if he's too silky.
Spencer,
I
man,
don't
thank
know,
you so much
Spencer,
for
Ryan, you
taking the
guys got
time.
closing remarks or anything?
Yeah, I just want to thank everyone for still hanging out with us an hour and 40 minutes into it. But I want to thank Spencer for taking the time, man. Really good to be able to chat with you, and you're crushing it. You're an inspiration. So keep up the good work, and yeah, just thank you so much for hanging out with us today. It was really fun to chat with you, and I hope we can do it again soon.
We'll definitely have to do it again. Thank you guys for having me on. Thank you for the insights, for the influence from you guys. You've shaped a lot of what my channel has become and the style of content that I do. So I appreciate you guys. I appreciate creators like you that aren't in this for the wrong reasons, that are in it truly like you were speaking about, Ari, for the betterment of all investors for sure.
Yeah. Well,
So
thank you,
that,
man.
investors, drop those comments down there below. Of course, subscribe to Spencer's channel if you're not there already, because he's dropping a lot of good insights. And with that, we'll catch you in the next episode of The Deep End.